So when you're looking to build a passive income machine from dividends with ETFs, I think a great place to start is with the Schwab US Dividend Equity ETF. And there are many reasons for this, but the biggest reasons are it has a roughly 4% current yield, which is much higher than a lot of its peer dividend growth ETFs. Has a very low expense ratio of just 0.06%. Doesn't use any leverage. It has over 100 individual holdings, which are all blue chip dividend growth stocks, giving it a sense of safety in numbers and diversification. And due to having all those holdings, it's also well spread out across numerous sectors of the economy. And best of all, it has grown its dividend at over an 11% annual growth rate for the past decade. And it's grown its dividend every year since being launched. So it's a very reliable and powerful dividend growth machine. Now, that being said, SCHD does have a few shortcomings, and they mainly come in the diversification department, and also some would say the 4% yield is just a little bit low for them to be able to reach their income needs in a reasonable amount of time. And so those are two big shortcomings, and those can be fixed with diversification to other sectors. For example, SCHD lacks much in the way of exposure to mega cap tech stocks like Nvidia, Apple, Amazon, Meta, Microsoft, Alphabet, Tesla, etc. And the reason for that is simple. None of those stocks pay out much in the way of dividends or even dividend growth. Yes, some of them do pay a dividend, like Apple, for example, and Microsoft, but they have very small yields and they're not known for their dividend growth prowess. And so you can invest in other funds like the JP Morgan Equity Premium Income ETF, the JP Morgan NASDAQ Equity Premium Income ETF, and others who employ notional covered call strategies on top of underlying portfolios that have significant exposure to those mega cap tech stocks. And so that's a popular way to keep meeting your yield objectives, in fact, enhancing your yield, because those stocks pay out high single digit to low double digit annualized yields while you're still getting that exposure to the mega cap tech space. Then there is another option, you can get more exposure to the infrastructure and utility space, which is also lacking in SCHD's portfolio, with funds like the Reeves Utility Income CEF. It's ticker symbol UTG. That's another popular one. You can also get exposure to the BDC space through various BDC ETFs, such as BIZD is one that's popular, and certainly REITs are also one that is largely lacking in SCHD's portfolio, with funds like the Vanguard REIT ETF, VNQ out there that can fill that void. And so there are a lot of options. Now, in today's video, I'm going to talk about JEPI in particular and why I think that one is actually not a good ETF to pair with SCHD. And then I'm going to share a couple alternatives I think out of these that I just shared that I think are particularly good fits for SCHD. Before I get into the video though, if you could please give it a like, that would just be a thank you to me personally for putting in the time and effort to make this content for you for free. That would help me to get better distribution of the video and grow my channel better. Thank you so much. Also, if you could subscribe to the channel if you want to get more content like this moving forward, that would be greatly appreciated as well. Thank you. Okay, so why do I not think that JEPI is a good complement for SCHD? Because after all, it does have a significant exposure to mega cap tech stocks. It has that high yield that juices the yield for SCHD, so doesn't it solve the issues? Well, the answer is really simple here, and that's every investment you make in the market is a trade-off, right? Because that money could be invested in something else. And so I just mentioned JEPQ. That's one that I think is a much better fit for SCHD, and the reason is simple. It better fits the need. It better meets what SCHD is lacking, namely the mega cap tech play. JEPQ is based on the NASDAQ, very similar to the NASDAQ 100 in its underlying index, whereas JEPI is based on very closely on the S&P 500 in its underlying index. And JEPQ is a little over 50% exposure to mega cap tech, whereas JEPI or the S&P 500 is only about 30 to 33% invested in the S&P. So there's significantly more exposure with JEPQ. And so JEPQ actually better rounds out your holding in SCHD. Now, perhaps if you're wanting to go like 50-50 between the two, maybe you'd want JEPI because maybe you don't want quite that much exposure to mega cap tech. But even then, if you have 50% of your portfolio in JEPQ and half of that is in mega cap tech, that's only a quarter in your mega cap tech. That's still less exposure than you would get if you just held the S&P 500 index fund, which is roughly a third in the mega cap tech. So I really don't see the need to do that. And personally, I would try to keep your exposure to these covered call funds like JEPQ and JEPI to a minimum, because they're not ideal long-term compounders, because that covered call index means that anytime you have a market crash with a V-shaped recovery or a sharp recovery, such as we just saw in April, we saw that during the COVID crash as well, they tend to underperform because they participate fully in the downside, and then the covered calls cap the upside during sharp market rallies. Whereas if you have a more gradual recovery over time, then those are more ideal instruments because you're not giving up that upside in short periods of time. But inevitably, you're going to have some of those V-shaped recoveries, and especially nowadays in the current setup with so much information getting disseminated quickly, all the algorithmic trading, all the money in hedge funds, etc., stuff can rebound very quickly as soon as narratives change. There's a headline that, oh no, massive tariffs, oh, they're suddenly suspended or even altogether done away with, and it's like quick recovery. Or COVID's going to end the world. Oh, well, actually, it's not as bad as we thought it was. Quick recovery. Could happen with a rumor of a major war. For example, say if China did something around Taiwan that caused the markets to panic, and then suddenly it was settled and resolved, it was a false alarm, market will quickly recover. Same thing. So you're setting yourself up for some serious issues there by pursuing that fund. I'm not saying there's no place for it in your portfolio, but I think you should keep your holdings to a minimum. Therefore, you want to get maximum punch out of it. And so I think a fund like JEPQ, which is virtually entirely focused on tech and especially mega cap tech, versus at 50% of it, versus something like JEPI, which is more of a diversified play. Again, it just doesn't make sense. You only want a fund that's that diversified if that's like your core holding. But again, you don't want a covered call fund as your core holding. So for that reason, I do not think JEPI makes sense for someone who's a dividend growth investor looking to live off of dividends for the long term with SCHD, for example, as the core holding. Now, JEPI, again, I don't see how it makes sense really for anyone, because even if you're not doing that, why would you want JEPI? Why not just buy the S&P 500? You have a lower expense ratio. You wouldn't have that capped upside. So again, I just don't see the place for JEPI. It sounds nice. It's clearly been a wildly popular fund as the assets under management have surged over the years, but I just don't see where it fits into a portfolio strategy. If you can think of one, please let me know in the comments below, but personally, I haven't been able to think of one. I think JEPQ does fit that niche much better, and there are a few other funds like QQQI that can do that well too, and perhaps some others out there as well. So again, I just don't see it. Now, the other fund I think that's a good fit that does make sense a lot with SCHD is UTG, which I mentioned, the Reeves Utility Income ETF. Again, it's primarily invested in utilities. It also has some other infrastructure companies out there, but I think it's a good fit because, again, SCHD hardly has any exposure to utilities or infrastructure. So it meets that need. It also has some AI plays in it, AI energy companies that are going to profit from the AI boom. And so that really works well with a fund like, say, JEPQ to complement SCHD to really give you more of an AI exposure, because that's probably one of the biggest flaws with SCHD is it just doesn't have the major leading AI winners in its, at least initially, in its portfolio. Now, some of those companies could emerge later on and benefit from AI, but they're not AI plays per se. So again, that's another reason to really like UTG. Again, UTG also has a high yield that could work alongside JEPQ to complement SCHDs to bring it up. It's currently around 6.5%. It pays monthly just like JEPQ, whereas SCHD pays quarterly, so you get that nice balancing factor there. UTG has never cut its dividend. It's paid it ever since it launched, even before the great financial crisis. In fact, it's hiked it several times over the years, so it's actually generated pretty decent long-term dividend growth along with that diversification, that monthly pay. It's, as a CEF, it does fluctuate between a premium and a discount to NAV. It's historically traded roughly in line with NAV, and currently it's trading actually at a slight discount to its average valuation over the past 52 weeks. So it's actually a decent time to buy it on that front. And again, the active management has generated long-term outperformance from a total return perspective, whether it be in terms of its index, which is like a CEF index from Morningstar, or even just the XLU utilities ETF. So no matter how you slice it, UTG has been a pretty good fund. So there you have it. I think JEPI is way overrated as a fund in general, but especially for a dividend growth strategy. I think SCHD is a great core holding, and they can be complicated nicely with JEPQ and UTG. Hope you enjoyed this video. Again, if you did, please give it a like, subscribe for more content. Thank you so much. See you next time.